today because they want to hear us talk about Spotify's earnings, who reported this week. Do we want to start with that?
Sure, that's fine. Yeah, we had someone ask, and thank you for asking Twitter to discuss. Yeah, interesting report. I don't know, Ryan, do you want to kind of give your maybe the overview first, and maybe I can bring up the report and give any context for numbers if we forget.
Well, to be honest, I wasn't a fan of the report. There were some positives, but in general, I'm starting to become a little frustrated. And honestly, it synced up right in line with, okay, I watched that. I know this shouldn't matter, but it does. I watched that show on Netflix called The Playlist, and obviously this was a long time. It was basically the show is based around when they were starting the business, primarily, and it's very much a growth mindset, and you're really focused on just not really things that drive value in the public securities world. It was more, how do we get to scale? How do we get to IPO? How do we disrupt music? That kind of thing. Doesn't really matter about generating cash. And that was kind of the focus of the show. And then when I watch when I read the earnings and I see kind of this constant deferral of profitability, where the focus was basically, and to their credit, they had a really good quarter user wise. I think they were 6 million MAUs above what they guided for. I think they're at what, 459 million.
Do you want me to give context here?
Yeah.
To start. So yeah, 456 million MAUs, 20% growth, 23 million in the quarter compared to Q2. So 23 million net additions in the quarter, which was a record high. And then premium subscribers growing a little slower, but it's still at 13%. So those are the paying subscribers. However, and this is what Ryan is talking about, gross margin still only 24.7%. Basically the same thing, same as where it was in the 2017-2018 period. And then operating margin is still slightly negative. So yeah, continue, Ryan.
Yeah. And basically listening to the conference call, they keep saying stuff like, so first of all, a lot of the thesis for investors today, and my thesis generally, is around operating leverage, that they're going to see some, not a crazy amount, but some operating leverage in their business as they reach scale, not only in the music side, but because of podcasting and stuff like that. We simply are not seeing that play out. And I know now it's a bit of a mix shift because podcasts are hurting and premium is growing a little bit in terms of gross margins, but it's 24.7% gross margins versus, I think, 24 point something percent when they IPO'd. If you
It's
look at
essentially the same. Really, no, it's the exact same on.
Yeah. And when you ask questions on the conference call, or analysts ask questions, it's basically, and listening to it, Daniel almost got defensive at the start by saying, I know a lot of you guys are going to be frustrated that we aren't seeing the margins, but we don't manage for the quarter. We worry about the lifetime value and hitting our internal metrics. We measure it differently, essentially, internally. And they keep using this like we're doing well internally. If it's doing well internally, it would show up externally.
Well, they could be right, but I agree. It should show up. It should show up in at least the gross margin numbers. And yeah, they said 2023 is going to be when they expand. I think investors probably have to hold their feet to the fire there. And if they don't, then maybe they're not as either two things. They didn't execute as well. They're not actually locked in on expanding margins. I thought, yeah, the quarter, look, besides the margins, the quarter I thought was really strong. They showed a lot of good stuff on engagement. And then on that movie stuff, Ryan, I mean, come on, that's irrelevant. I know it's kind of a joke, but
Is it though? Because
it's pretty. I mean, I think the book that the movie was based off of, that is actually trying to be factual, is relevant. So I'd recommend anyone read that to give the true historical context. And yeah, they do focus a lot on.
I mean, they said, I guess Martin said that the
That's
book was,
not, that's not, I
or
mean,
not Martin, the old CFO. He said the book wasn't indicative of what happened either. The
but the movie was even more exaggerated than the book. So I don't, or not the movie, the TV show. I don't know if that should factor in any sort of investment thesis.
well, I
Um,
think okay. I think the proof's in okay. The way I see it, management teams seem to measure success one of two ways. The good ones measure it in cash flow for shareholders. Others measure it by the size of the business in terms of influence and employees. And my concern in watching that show is that they really seem focused on disruption and the size of the operation and employees. And yes, they probably made it seem, I mean, if
well,
you're a
that could be
shareholder, it's easy.
if the show didn't come out, that could still be true, and I think it might be true.
Yeah, there was, I mean, there was
Hey,
one,
hey, we should say on the conference call, they did answer my question though. So, I mean, that's a huge highlight of the quarter. Finally got a question answered there.
yeah,
That
yeah,
is huge. That
that's
is,
pretty cool, I guess. Um, I do, and you're gonna roll your eyes when I say this, but I'm pulling up a quote from the show. Obviously, keep in mind it's from the show. This is not real
yeah.
Martin.
I mean, you know, it's
Basically, when talking to when they said, "Well, you got to figure out the business eventually, right? You got bills to pay." He said there was this whole scene where he basically it really didn't make a whole lot of sense, but at the end he goes, "By then we'll have shareholders, thousands of shareholders. They're the ones who will pay the bill. Growth, growth, growth." Now, the reason I took that out is because it feels like that's what's happening when I read through these earnings releases.
yeah. And look, I think I could agree with you. I don't really, like I just said, don't really put any factor into the TV show, but that could definitely be correct. Um, and it comes back to, I know any sort of the bull thesis in spite of that would be, oh well, it's like Amazon, and I know that could be the case, but Amazon type investments where you don't generate cash as a public company for, or consolidate cash for, what would it be for Amazon? Maybe, what was it, 20 years? Yeah, probably less, a little less than 20 years, 15 years, something like that. And you actually are able, to, I don't, I mean, here's the thing. They,
I think a good rule
if,
of thumb is no one is Amazon.
yeah, most likely 99.9% chance. The thing is, though, is that it's hard to look at them because Spotify, I'm saying it's hard to look at Spotify, and it's why the stock is down so much, and why if they execute and kind of run any sort of numbers on margin expansion, the stock's going to probably do extremely well. Is that if they are not just making excuses and the operating leverage is there, and they say will show up in the consolidated numbers and does show up in the consolidated numbers in 2023, on at least the gross margin level, and they're investing and getting tons of strong returns on that investment. I mean, this is a chance to be a ginormous company. However, it's really hard to see that um, today, and it seems like each quarter they come up with another excuse of why consolidated numbers don't look great. Uh, and
But
yeah,
internal numbers.